Most of you know that 13Fs are one of my favorite things to look at for investment ideas. I have found countless of successful investment ideas actually from looking at 13Fs, although the most profitable ones were not from someone as popular as Michael Burry, but I would still like to look at some of the things that he bought. But the only problem with Michael Burry is that he's in and out of stocks a lot. So I try to look into stocks that are actually somewhere close to where they were between January and March. And one of those stocks is actually Signet Jewelers, SIG, and it's around 9% of his US portfolio in his 13F. And if you look at Signet Jewelers from pretty much January, it was around $78, and now it's around $70. So there's a pretty decent chance that Michael Burry is still in this investment, and it's pretty much at the same level it's been at since the start of the year. So I'm gonna look at Signet today, analyze their potential, why Michael Burry potentially bought it, the risks, the upside potential, and everything in today's video. Now, if you actually look at the stock, it's been crazy volatile. Even if you zoom out a little bit, it used to trade as high as pretty much $150 per share. And in the pandemic, it went as low as $7.50 per share. And then it went from $7.50 all the way up to 111, and now it's back at 70. So it's a very volatile stock. It's all over the place, and this is for very good reasons. Now, Signet Jewelers actually owns pretty popular banners that most of you could be familiar with, or most of you have actually seen. For example, something like K Jewelers. Maybe you've been walking in a mall someday and you've seen something like K Jewelers that's pretty popular. Same thing with Zales, same thing with Diamonds Direct. I've been seeing Diamonds Direct's ad pretty much all over the place, where I live. And these are pretty popular brands. Even Jared, I'm sure you've heard about one of those banners, or you've actually seen them. So it's pretty popular brands in jewelry. Now, you might ask yourself, why would Michael Burry buy a jewelry stock if we're in a recession? If we're in an economic slowdown, people don't have a lot of money to spend, we have high inflation, why would Michael Burry buy something like a jewelry stock or something? Well, the main reason for that is 50% of their sales is actually bridal. And this is one of the reasons why the stock went down so much in March 2020, was people were not getting married. And they were not just engaging. They were not doing all those things they were doing when we had COVID. So the demand for bridal jewelry and for those occasions actually dropped a lot. But for Signet, 50% of their sales is actually bridal. And if you look at their sales before, their revenue was actually pretty stable from 2016 almost to 2021. It went down a little bit, and then in 2022 they expected pretty much flat revenues. So it doesn't grow a lot of revenues, but the revenue profile is pretty stable because bridal is less cyclical than something like birthday gifts or something else. So it has a higher chance of holding up much better actually than others if we are now in a recession or an economic slowdown. And bridal also has much higher margins. Now, there was a lot of risks with the company, and they actually went through a lot of restructurings. They got rid of all the bad businesses. Actually, those businesses like Diamonds Direct are new businesses that they acquired last year, I believe, and they had something that was pretty bad in their profile, where they actually had their credit, services, the financial services within the balance sheet. So they were providing the financing, taking on the credit risk. Some people were paying, some people were not paying, and there was pretty much a lot of things. Well, actually now they completely outsourced the credit pretty much operating model, and this has helped reduce the risk with the company. It has helped the balance sheet actually looks much better than it used to, and they pretty much delegated the task of financing to other companies or to something like Affirm, or you could buy now and pay later, and things like that. So it's much safer and it's a much better company than it used to be before. But I did talk about the revenue is pretty much flat. It doesn't really, go up a lot. And if you actually look at the same store sales growth, it's always pretty much flat to up. So if you look at the stores that they actually operate, they either decline in sales or they're pretty much flat, with the exception of 2021, which is the fiscal year 2022 after COVID. Of course, they had a big spike in same store sales, but it's pretty much flat. And the main way this company has been able to actually sustain and grow revenues a little bit is by doing doing a lot of acquisitions, like the acquisitions they did, with what I showed you with Diamonds Direct, with, I believe, Jared is a new acquisition, Banter is a new acquisition, and a few others of their name, which have been proven to be very, very successful. Now, if we look at how much we're actually paying for this thing, this company issued their 2024 guidance. Now, 2024 is a fiscal year, is for 2023, which means this is for this year that we're in. Now, their guidance is between $11.07 to $11.59 of non-GAAP EPS, which would actually equate to only 6.5 times earnings. So the company is just trading at 6.5 times earnings. In my opinion, this is actually, it looks pretty attractive. 6.5 times earnings, 50% of their sales is bridal, which is less cyclical than other companies. It just went through a restructuring phase, and they also have pretty good return on capital for such PE ratio. Normally when you're paying 6.5, they have like 1, 2, or 3% return on capital. But something like Signet actually has higher return on capital between 16%, 8 to 9%. And over the past 2 years, whenever they did those acquisitions, their return on capital were 23.5% to 19.5%. So for what we're paying, in my opinion, it's a pretty fair price if those earnings are sustainable. And if we look at the balance sheet of Signet, it's actually not as bad as you think. Normally when you see something at 6.5 times earnings, you might think they have billions and billions of dollars of debt, which is actually not true. The company has $1.1 billion of cash and cash equivalent. Their current assets are $3.5 billion. Their current liabilities are $2.2 billion, which means they have more in current assets than current liability, which is something good. Their long-term debt is only $147 million. So it's actually not bad at all. $147 million of long-term debt. They have around $1.5 billion of cash and cash equivalent. So the balance sheet, in my opinion, it's very, very good. And they have, the lease liabilities, $894 million. You could count them if you want. Normally, I don't count them as debt because they don't pay interest on it. It's just the cost of doing business. So I don't really count on it. It's the same thing with deferred revenues. If you have any questions on those, you could ask me in the comments and I can explain to you, what I mean by each one. But I personally believe the balance sheet is actually not bad for this company, even if it's trading at 6.5 times earnings, which is not expensive in my opinion. Now, the main upside I see with something like Signet is pretty much two main ways I could see some upside with the company. The first way is if they just revert back to their mean PE ratio. Now, in this chart, I looked at what Signet was trading at from between 2008 to pretty much 2019, pre-COVID, because the figures are very distorted on COVID. It's up and down all over the place. So the company traded as high as 21 times earnings at a mean of 12.5, pretty close to 13. Now, the company is actually lower than when I recorded this. It's around 6 times earnings. Now, 6 times earnings, it used to trade at 12.5 times earnings. If the PE ratio goes back to the mean, this is more than a double on the company if the sales and the net income margins actually pretty much stays flat, if they experience no revenue growth, if there's some type of sentiment that the company is better than it used to be because they don't have credit exposure like they have less cyclicality with their new acquisitions, which is more on bridal than what they had before in terms of discretionary spending. So if sentiment changes with the company and the PE ratio goes back to 12 times earnings, which is with this kind of balance sheet, it's very possible, in my opinion, this is more than a double on the company. Now, there's something else that I can say that maybe could actually be some upside with the company. It's actually from their own targets, which I don't put a lot of faith into, but they have their midterm goal between 14 or 16 of non-GAAP EPS. And if you look at what they mean by midterm goal, which is over the next 3 to 5 years, in my opinion, I don't take something seriously like that. I just try to look at what they're making right now, not at what they're trying to be 3 to 5 years from now. But if they ever get to 14 of non-GAAP EPS and the company trades at 10 times earnings, this is $140 per share. This is more than a double of where Signet is trading at $70 per share. And they expect to have 11 to 12% market share because they want to take the free cash flow and do more acquisitions and reinvest the free cash flow. Now they are around a 9% market share in the US, I believe, and they said they're trying to get between 11 to 12%. Now this is all very, very possible. Now there's a risk with the company that we talked about, but I'm going to try to discuss it a little bit more. It actually helps that 50% of their sales is bridal, which is less cyclical than something like birthday gifts or Christmas presents or something like that. And it's actually higher margins. But the problem is that a lot of people buy these type of jewelry on financing. And we used to have 0% interest rates, and these numbers were inflated and everyone can pretty much afford it. Now we don't have 0% anymore. We have maybe 18% on such things. Maybe the buy now, pay later. Maybe 19, 20%, maybe 15%, maybe it's little as 10%. So it's not 0% anymore, which means that yes, bridal is less cyclical than other areas of the jewelry type of business, but it doesn't mean that sales cannot decline because of the high interest rates we have. We're still in a recession. Maybe people have to pay back their student loans very, very soon. So earnings might actually be lower than their target of, I believe, was something around $10 or $11 of EPS. Now, in this case, if earnings are down 20 or 30%, the company is still cheap. I mean, it's still trading around 6.5 times earnings. Now, if the earnings decline 20, 30%, it could be at 8 or 9 times earnings, which is actually still cheap, in my opinion, for the company. But the stock, of course, might go much, much lower, in this case. Now, after looking at everything with Signet Jeweler, I personally believe that the company is undervalued. They might experience some decline in sales, but a lot of the bad is priced in the stock around 6.5 times earnings, and they're expecting their EPS to grow to 14 EPS per share 3 to 5 years from now, which I'm not counting on, but they are expecting more and more EPS growth. Now, if that ever happens, there's over a double on the company, in my personal opinion, but the downside could be 20 to 30%. I mean, I could easily see the company going back somewhere around $51, $52 per share if they do have to revise their guidance lower as we have higher interest rates. Maybe they didn't account for it. Maybe, sales are going to reverse, but I could see it, go as low as $50, $52 per share if something really bad happens. But if everything stays the same and then there's no more cyclicality in the industry like there was before, I can see Signet trading back at 12 times earnings, which is more than 100% on the upside from today's prices. So I tried to put in some research in this video. I hope you could do your own research and come up with your own conclusion. If Signet Jewelers is a buying opportunity for you, there's still a 1% dividend and some buybacks that they're trying to do. So I hope you take everything into consideration, and it's not financial advice. So I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another one.